Hello, and welcome to the Mr. Darston's Money Mastery Made Simple online course. I'm looking forward to guiding you down the path to become the master of your money. In this course, you will be provided with tools to help you save and understand money like never before. You will get equipped with knowledge that will teach you how to get money working for you. And you will also be given strategies and techniques to help propel you to the future wealth you desire. For this portion of our lecture, I'll be covering the first three chapters where we will discuss topics encompassing where money came from to how you get your hands on more of it. Let's begin. In this chapter, we will discuss how to use your goals and objectives to determine an investment strategy and time horizon, how to open an investment account, how to select an investment vehicle, what the stock market sectors are, the value of your employer sponsored plan, and the value of rebalancing. We will begin, however, by defining what investing is. Investing is the act of allocating funds to an asset or committing capital to an endeavor like a business, a project, or even real estate, with the expectation of generating an income or profit. Your savings becomes an investment when they are used in order to generate more money. Think of investing like this. It's a means by which you attempt to ensure that the money you have today maintains and grows its value so that in the future it can be used to help you and those you care for live out your goals. Consider your future goals and ask yourself what it is that you want to bring to fruition and prepare for. Some examples may include not running out of money in retirement, buying a dream home, paying for your child's education or wedding, and there can be various other priorities as well. Doing this will help you bring into focus your investment goals, and it will also be important in determining the investment time frame you will commit to, as you will be setting dates for when you want to realize each goal. Evaluate the level of risk and volatility you'll be comfortable exposing your investment dollars to by deciding whether you want to pursue a conservative, a balanced, or an aggressive strategy. A typical rule of thumb is to link the strategy to your time horizon by being more aggressive for goals further out into the future and less aggressive for goals with less time. A conservative portfolio generally allocates a large percentage of the total to lower risk positions such as fixed income and money market securities, and may hold up to a third or less in more aggressive positions like equities. A balanced portfolio is typically composed of almost equal weights between fixed income securities and equities. An aggressive portfolio mainly consists of equities, and its value will fluctuate more than conservative and moderate portfolios. Once you determine how to fund your strategy and you determine the risk tolerance that fits your strategy, you will need to open up an investment account. Opening an investment account will typically require you to either meet with a financial professional or go online and or download an app if you wish to establish a self-directed account without the services of a financial advisor. We will cover three types of self-directed accounts you can open. We'll start by talking about a brokerage account. A brokerage account is an account an individual can open that is an investment account which allows you to buy and sell a variety of investments. That includes stocks, bonds, mutual funds, and exchange traded funds, which we call ETFs. Many well-known brokerage platforms exist. They include TD Ameritrade, Merrill Lynch, Vanguard, the more online type brokerages like Robinhood, TradeStation, and Webull. Next is a direct stock purchase plan where you can buy stock directly from the issuer of the stock. The benefits to a direct stock purchase plan include not having to open up a brokerage account, but the drawbacks include not being able to trade the stock for other securities through the company issuing the stock. Finally, there's buying mutual funds directly from a mutual fund company. This will allow you to access a number of mutual funds, but will limit you to funds managed by that mutual fund company's management team. Both the stock purchase plan and the mutual fund company direct purchase limit the amount of product diversification you can have, as they'll either offer just a stock or a number of mutual funds. You won't be able to buy ETFs, trade options, or anything like that with the final two. You must get a brokerage account if you want the maximum flexibility. Another part of the planning and goal setting process involves determining how you will fund your accounts, as your funding strategy can have an effect on your account's performance. A strategy many have found success employing is funding their account with a large lump sum into a safe and liquid investment like a money market fund, and then making subsequent ongoing deposits in more growth oriented positions, while at the same time doing what's known as dollar cost averaging out of that lump sum money market position into equities, bonds, and other securities that can give them a better return over time. Doing that will get your money into the account and allow you to have a little bit of time to decide what your actual investment strategy will be and how much risk you're willing to take and how much growth you're going to pursue in your account. The investments your account offers will typically fall into one of two categories. One, fixed income investments. Two, equities. Fixed income investments include products like CDs and money market accounts. Those products typically offer a guaranteed rate of interest, no downside market exposure. The other fixed income investment type is a bond. Now, a bond represents a loan made by an investor to a borrower. A, a bond could be thought of as an IOU between the lender, represented by you, the investor, and the borrower that issues the bond. It includes the details of the loan and its payments. They are used by companies, municipalities, states, and sovereign governments to finance projects and operations. If you own a bond, you are in effect a creditor of the issuer of that bond. Now let's talk about a stock, or what is also known as an equity security. It is a security that represents the ownership of a fraction of a corporation. Owning equities entitles the owner of the stock to a proportion of the company's assets and profits equal to how much stock they own. Units of stock are called shares. Once you determine how to fund your strategy, the level of volatility you're comfortable being exposed to, it now becomes time to select the investments that fit your strategy. You can choose to buy individual stocks or bonds. An advantage of doing this is that a stock is a liquid vehicle that's actively traded throughout the day. It offers its owner direct access to the market growth of a specific company. Apple, Amazon, Tesla in recent years have all been companies that have had great individual exponential growth. The owners of those stocks have been very pleased. Now, though you can buy individual stocks or bonds, when investing for the long term, many have found it beneficial to use investment vehicles that offer a level of diversification that's not found in an individual security like a stock or a bond. The most common vehicles offering this level of diversification would be mutual funds and exchange traded funds, or ETFs. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase securities such as stocks, bonds, money market instruments, and other assets. Mutual funds are professionally managed, and their portfolios are structured and maintained to match the investment objectives stated in its prospectus. Advantages for investors choosing to invest in mutual funds include advanced portfolio management, risk reduction through diversification, convenience, daily liquidity, and a variety of offerings. It is, however, common for mutual funds to have what's known as a sales load, where its purchase price is more than its net asset value, which is the amount that it trades for. What that means is that the buyer will pay a premium to acquire the fund shares. It's sort of like if you wanted to get access to a bar and there's a cover charge, where you could get in, but you have to pay the cover charge to get access to the bar. Same thing with the sales load on a mutual fund. Now, an ETF is a type of investment fund that is an exchange traded product that's traded on exchanges, just like stocks are. So it's traded throughout the day. ETFs sort of provide the best of both worlds as they are actively traded, as I just mentioned. They don't have a sales load. But like mutual funds, they offer a portfolio of stocks to help mitigate the risk of investing in a single stock. Each vehicle can be beneficial, whether you go stocks, mutual funds, ETFs. But for the investor looking for maximum diversification, all day liquidity, and minimal cost, ETFs meet all criteria. I bet you're familiar with the old saying, don't put all of your eggs in one basket. That saying is very relevant in investing, as time has proven that diversifying where you invest your assets by using various asset classes in various market segments can help to reduce the volatility in your portfolio. As of the construction of this course, there are basically 11 sectors within the stock market you can choose to be invested in, and each sector has subsectors called industries. Now, the beauty of being able to diversify across sectors is that all sectors don't perform the same way at the same time. For instance, we could have a year, a month, a week where the financial sector is going on a bull run, just going up, 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 while at the same time the energy sector may be stagnant. Well, the consumer services sector may be having a negative turn during the same time. By diversifying, you protect yourself from being in the one industry, the one singular industry that may be going down at a time. So, utilizing a diversification strategy by having a multi-sector investment approach can help stabilize your portfolio. If you are employed and your employer offers a retirement plan, it is almost always recommended that you participate in your employer-sponsored retirement plan. Reach out to your HR department or scroll through your company intranet for enrollment details. Many company sites will have a life and career section you can click on, and from there may be a section entitled something like benefits. Once you make it to the benefits section, look for a link that says something to the effect of 401k savings. It's advisable to invest up to the amount needed to obtain a company match, as many companies will match a certain percentage of your contributions. That way, you can maximize the amount of free employer money contributed to your account. Now, you do need to be advised that employer-sponsored retirement plans are sponsored by the employer, and that means that they, the employer, gets to predetermine what investment options you can select from. There's often a limited menu of choices. For this reason, it's recommended that you open up and fund an additional investment account outside of your employer's plan, as your employer plan has limited investment options and also may have some withdrawal restrictions that make it difficult to get to your money before you reach a certain age or before you separate from service. Once you select and fund your investments, your balance and how you're allocated to each investment will start fluctuating. Over time, the fluctuations may become significant, and a significant change in allocation can affect how much exposure to risk you assume and can result in you finding your account's allocation mix being outside of your designated strategy. To remedy this, you can employ rebalancing. Rebalancing is the process of realigning the wings of a portfolio of assets. It involves periodically buying or selling assets in a portfolio to maintain the original or desired level of asset allocation and risk. Now, with rebalancing, the one thing you need to be uh, aware of is that doing so more frequently than annually can result in a taxable event. Now, non-qualified after-tax accounts are really where you'd have to worry about this, as IRAs, 401k retirement accounts. Uh, the growth is tax deferred, so you don't have to worry about rebalancing causing you to have taxes. But if you have a retail account that's after tax, rebalancing any more frequently than annually can result in a short-term capital gains that will be taxed to you as ordinary income as opposed to being taxed at the lower capital gains rate. Because of this, most people are content with not rebalancing any more frequently than annually. Okay, now it's time for us to bring home what we've covered. If you have a pen or pencil, this would be a great time to take some notes. First, you must take time to examine what the goals you aspire to are, as well as the things you must be financially prepared for are. Make a list and be honest about what it is you want. Even if it seems audacious, that doesn't matter because you're developing a plan to get you there. You're developing a plan to get you there. You're developing a plan to get yourself there. Be excited. Secondly, open an investment account. If you will be handling investing yourself and want maximum flexibility, I recommend opening a brokerage account with a reputable firm that offers no commission trades like a Merrill Edge or Fidelity. There are many others as well. Once you open your account, link it to your bank account immediately and start funding it. Doesn't matter whether it's an initial lump sum or bit by bit consistently over time. Next, decide how aggressive you want to be and start looking at the different market sectors. Examples include healthcare, financials, materials. Also, look at the type of securities, stock versus fixed income, and design a portfolio that spreads your money across multiple sectors and types of securities based on the percentages that match your desired level of aggression. Let me give you an example. If you decide to invest in a balanced portfolio, that means you're going to be basically in a 50-50 portfolio where 50% of your assets are in fixed income based investments and the other 50% are in equities or stock. Where now, if this is the case, you want to look at multiple sectors for the 50% you have in equities and spread your money, the money that comprises that 50%, across multiple industries to maximize your diversification. You want to try something similar with the 50% in fixed income by having a portion in money markets, a portion in corporate bonds, some in high yield bonds, and a portion in U.S. Treasuries. Doing this will stabilize your portfolio and help you to benefit from growth across various sectors. Do this in your employer plan as well as your individual plan also. Do not forget to rebalance your portfolios annually. If you do these things, you will all but guarantee yourself to have long-term success investing and you will build your wealth so you can achieve your dreams. Let me repeat that. If you do these things, you can almost assure yourself of long-term investing success and you will be able to achieve your dreams and goals. Isn't that exciting?